We need more thoughts. Tracie McMillion has them for us, Head of Global Asset Allocation Strategy for Wells Fargo Investment Institute. Did you see this sort of rate of change in the bond market, and how is it affecting the rest of your asset allocation, Tracie?
Yes, so we do have a target on the 10-year of 2% to 2.5% by the end of this year. Maybe not have expected the 2-year to get here quite this quickly, but with the Fed pivot, what we're seeing is that these higher yields on the 10-year is really giving the Fed some cover here for multiple rate hikes this year. And in that type of environment, you look at your asset allocation across stocks and bonds. We still like stocks over bonds. Even at 2%, we're still seeing negative real yields there, but they're starting to get a little bit more attractive to us. We also like higher quality here with this volatility that we've seen.
Yeah. Do you think, though, that's going to stick? I mean, even on a day like today, and I know this is just one single day, Tracie, you start to see folks start chasing some of those momentum names in a way that we haven't seen really for the entirety of this year so far. When we get into the actual rate tightening cycle, assuming that kicks off in March here, do you think that's going to be enough to keep people wedded to those value names, or I guess the names that are a little bit less growthy?
Yeah, I mean, you're right. We haven't even seen tightening yet. In fact, the Fed is still purchasing bonds, so they're still accommodative right now. When we get to the point where they are starting to tighten, we could see some readjustment there. We may see some of the more cyclical type asset classes starting to suffer somewhat. So again, looking more towards things like we like financials with higher rates here. We also continue to like industrials, information technology, communication services. So some of those higher quality growth names we think will continue to prevail even as the Fed does start its tightening cycle.
Let's talk a little bit more about the Fed. Caroline chuckles at me when today, of course, the narrative of rates higher could be a good thing for equity markets. They're still signaling growth on the horizon, but the inflation story might be telling us a little bit of a different thing. Are you confident that the Fed can tackle inflation without stifling off growth too much?
Yeah, well, that's their challenge. And, we see the Fed going 25 basis points in March and then 3 other 25 basis point increases. And we think as long as they're cautious and they go slowly, that they can continue to tighten monetary policy without necessarily choking off growth. So what we think we're seeing in these higher rates today is some acknowledgement that growth is probably going to be pretty strong this year. It's going to be above average with the Omicron variant peaking in mid-January. That's another factor. So, the reopening trade can start a little bit earlier. We're seeing the possibility of positive growth here in the first quarter, whereas that was questionable earlier this year. So, yeah, we think that growth can persist this year, and Fed can thread that needle.
Talking of threading a needle, I'm going to go for the surveillance question here about a yield curve that is currently, at 61 for the 2s, 10s. Does it matter if we get some sort of inversion? Is the Fed in any way in a bind here? What is that trying to tell us, that sort of flatter yield curve?
Yeah, so at 60 basis points, we still think there's plenty of steepness there to continue this expansion. If we were to see an inversion, we were to see the 10-year come in, or, even the shorter end of the curve move higher, then that is more than likely signaling to us that this recovery is about to end. We typically see a recession 6 months to 18 months after we see a yield curve inversion. And last time we saw a yield curve inversion was 2019. And, at that point, we didn't see anything on the horizon that was going to push us into a recession. And then along came COVID, and we had the recession. So something was going to push us into that recession, and the yield curve certainly telegraphed it.
Tracie, I want to talk about investor sentiment a little bit, particularly in the context of some of the geopolitical issues going on out there, particularly with Russia, Ukraine, and how the U.S. and its European allies react to it. Is this something that you're seeing or hearing at all from clients that they're worrying about?
So we are. Obviously, anytime there are significant geopolitical issues in the headlines, it is something that clients and investors are concerned about. Usually, what we see is domestic policy kind of overshadowing a geopolitical event like the Russia-Ukraine situation. And, we don't necessarily think that an invasion is in the cards here. Instead, what we think we see happening here is just a continuing escalation of Russia's trying to destabilize the Ukrainian government and maybe even expose some cracks in NATO.
What do you see then as some of the biggest risks on the horizon, the biggest reason for some of the volatility out in the future?
So certainly the fact that the Fed did pivot in December, and we could see them raise rates significantly more than the markets are expecting today. That magnitude could be higher. Inflation could persist for longer than we think it's going to. At the moment, we think that inflation is probably going to peak here in the first quarter and then start to subside as we go through the year. But if it were to persist, then that would definitely be a threat to the markets that we're not pricing in today.